selective henceforth?
Yeah, so we turned tactically positive last month. So we're not like gone whole hog positive on the sector. We still think that there are structural pressures in the sector. We still think that it's not a structural buy. So the reason why we've gone tactically positive is that we think that compared to the financial sector, which has been the very large overweight sector for the institutional investors, we think that fundamentals are improving a tad, not very dramatically, and valuations have been on the lower side for the tech sector until very recently. On the financial side, the private financial, be it NBFC or be it the private banks, the valuations have been 2 standard deviations above the mean. So it's this kind of dichotomy between two, one seriously underweight sector from an institutional perspective and one seriously overweight sector, that has kind of led to this outperformance in our view. So we've actually shifted our target prices upwards, but 80% of the upside that has come for target prices being driven by PE multiple expansion, and only 20% has come from an earnings upgrade, so to speak. So we're still concerned about growth, but in the near term, it's this interplay between financials and IT, which is kind of going to give a little bit of a leg up for IT. So there could be a some bit more run up in the IT services sector from a aggregate perspective.
Once bitten, twice shy. Do you think Infosys will be not conservative, but they could be ultra conservative with their FY19 constant currency guidance, because they've gone wrong in the past, not once, not twice, but 3 times. Now with the new CEO, the first thing he needs to do is he needs to protect his reputation. And do you think he could end up just under committing and over delivering? Urmil, that question was for you.
Oh, okay. So, yeah, basically we believe that while the environment has improved, we believe that Infi would guide a CC growth of between 5 and 7%, or dollar growth of 6 to 8%. And we believe that given that third quarter was okayish, and in this quarter also we expect a steady performance from Infi. So the exit rate should help them achieve at least within this range.
What is the best way to look at the IT outsourcing pie? Because for 2016 and 2017, and for 2017, when the US economy was growing, it was not that IT companies came out with very rosy or very optimistic kind of growth. Suddenly now we are trying to connect the global economic growth with IT spending, but in last 2 years, if that pattern has not played out, why do you think this time it could be different?
If it is addressed to me, see, I think for 2018, I think one of the key drivers is going to be the US tax reform, which has kind of happened, which is going to lead to a fair bit of savings on the taxation front. We did an exercise on this particular issue, and we believe that S&P 500 company related taxation is going to go down. The effective tax rate is going to go down by anywhere between 300 to 400 basis points in 2018 calendar year versus 2017 calendar year, and it will continue to kind of glide downwards. So there's going to be a fair bit of savings, plus some of the cash that has been sitting in some of the tax havens is going to come back. So the sense we get when I look at the transcripts, when I look at the commentary, management commentary of S&P 500 companies, it looks like a lot of the cash is probably going to be given back to shareholders, either in the form of dividends or buybacks, plus some debt is going to be paid down, and there is going to be some amount of incremental spending, largely capex related. So we think that there is going to be some pickup in growth. I do not concur with the broad consensus street view that there's going to be very strong growth pickup and that's going to continue into FY20. I still think that the growth is going to be very modest. Growth pickup is going to be very modest, and it's not going to be well spread out. It's going to be concentrated in a couple of companies where we think that TCS and HCL Tech will probably deliver the kicker, a little bit of a kicker, 150 to 200 basis points higher growth in FY19 versus FY18 on an organic basis. So we do not subscribe to the view that it's going to be a huge kicker. We think it's a modest kicker and it's not a well spread out thing. So broadly, that's the view we have. Why change in view on growth? I think it's basically tax reform, which has been the catalyst in one sense.
Right. Urmil, I was just looking at some of the data that our research team pulled out and, did analysis on. From a valuation, pure, very basic metric of, sizing up these businesses. You have HCL Tech, which is at 15 times which is cheaper than an Infy and a TCS. With this new acquisition coming to the fore, don't you think that there's perhaps a low risk, high return opportunity in HCL Tech vis-a-vis Infy, TCS, irrespective of what they say today, Infy particularly?
So one thing is that the discount has always been there in case of HCL Tech. While the acquisition they announced yesterday, we believe it is very good, and on the business front supports their mode 2 and mode 3 solutions, as well as we expect it to be earnings accretive. But we need to keep in mind that almost about 60% of the growth that will come in for the revenue growth for FY19 will be a combination of the IP deals as well as the acquisitions. In our forecast, we have factored that TCS in fact delivers the best improvement in revenue growth in FY19. So we are expecting the growth to pick up by as much as 3 percentage points to 11%. So we believe that the discount to HCL Tech would continue to be there in comparison to Infy or TCS. But we think that TCS does have room to go for a higher multiple as it gets back to a double-digit growth next year, because it's right now it's just trading a tag above the median 1 year forward in the last 3 years. So it isn't expensive from that perspective.
Okay, Girish, as we try and wind down the discussion, what are the stocks within IT where you still believe there's a buying opportunity, and what are the stocks that you're still staying away from?
Okay, so when we upgraded the sector, our pecking order has been that we like TCS and HCL Tech the most from both the growth and the valuation standpoint. I think TCS's yesterday's run up and HCL Tech's run up yesterday kind of covers a lot of ground. So we still like these two companies the most. Below that would come Infosys, and after that would come your Tech Mahindra and Wipro. We do not like the mid-cap space, considering the kind of expensive valuations that they stand on. Most of them are like 80 to 20 times FY20 consensus earnings expectations. And we think that the business risks that are connected with these mid-cap companies are far higher compared to the tier 1 companies. I think the client concentration levels are far higher, and if one or two of these clients kind of shift away from these mid-cap companies, growth could potentially see a downside, which I don't think the current market is kind of taking into account at this point. So TCS, HCL Tech is what we like at this point from growth and evaluation perspective, and mid-caps is something we would want investors to avoid.
Gentlemen, so great to have you on the show today. Thanks very much for helping our viewers with the perspective that you had to offer on the IT space and where the sector is moving from here. We really appreciate your time.